Hello, everyone. Thank you for joining us. My name is Jason Shamtab. I'm a director and partner and wealth manager here at Aspiriant. I'm a CFP professional. I team up with my colleagues, working with all sorts of clients, entrepreneurs, executives, early stage employees, and so on, providing holistic wealth management, including helping people to optimize and think through planning for liquidity events, any other number of investment matters or financial planning matters under the sun. With me today is my colleague, Teresa Greenup. Hi,
Hi,
Teresa.
everyone. I'm Teresa Greenup. I'm also a partner and wealth manager at Aspiriant. I'm located in the San Francisco Bay Area, and I'm super excited to share today what we've learned over the years, and most recently in this environment, working with clients like all of you to plan around private company stock. There's a lot of tax strategy when it comes to equity compensation in particular, which makes it such a powerful opportunity for people to invest the time to understand and plan around it. If you're not familiar with Aspiriant, we're an employee-owned wealth management firm. We focus on financial planning and investment management for individuals and families across the United States.
Thanks, Teresa. And you may recognize, some of you at least may recognize the two of us from a previous liquidity webinar we did. Today is going to be a little bit different in that we're going to focus more on what you can do when there's a delay in a liquidity event. And so some tips, some tricks, and even some mistakes people make, as well as ways to optimize, that delay in those proceeds. A couple administrative items before Teresa and I jump into the good stuff. So there's a Q&A section at the bottom, which you can click on to put in any questions you have during the webinar. We'll do our best to answer those at the end. This will be recorded, so you can watch it again if you want to do so, or you can share it with someone you think might find it helpful. There's also some materials in the resource section you can check out, which have some really interesting information on equity, comp planning, and things of that nature. And last but not least, you will receive an email at the end of the webinar with the opportunity to do a free complimentary wealth planning session with Teresa or myself. So definitely look out for that. Answer any questions you might have about your financial situation, liquidity event, or otherwise. So that all out of the way, Teresa, let's get started. Let's keep this conversational. I'll just, to do so, kind of kick off a very general question, which is what are you seeing in liquidity markets right now, in conversations with clients and in general?
Yeah, so the good news is so far this year, we've raised, or in the US, the same amount via IPO or initial public offering as we did in all of 2024, with still 3 months to go. So far this year, we've seen just over 155 IPOs priced, but that compares to just under 250 in 2024. So that means the deals are bigger, but there are fewer deals. So there's still good traction, but definitely, room to go up to the 2021 levels, which were the high of all time.
Yeah, definitely seen a pickup, that's for sure, in conversations with people, talking with clients and, their private shareholdings or those who work at, companies that are they're waiting to go public, have a merger acquisition, tender offer, whatever it is. But there's still a backlog, I think, from the last few years of ones that were supposed to take place but haven't, and kind of those are now flowing through the funnel. So there's still kind of this I don't know, has a little bit of hesitancy because who knows what's going to happen for sure, but definitely positive signs overall. When you talk with people about it, clients, prospects, whoever it is, about the implications of these delays on their financial plan, financial lives in general, what are some of those primary things that get brought up where there's concerns about or issues that they're having?
Yeah, it can be really challenging to see a really large number on paper of, net worth that you can't have access to. And so first and foremost, our goal is to sit down and really figure out what your near-term goals are and prioritize them so that we can start to figure out if we need to tap into your equity in some way. if you don't have access to it via an initial public offering. And so that means putting pen to paper, and that helps us really articulate the amount that you want to take off the table should the opportunity arise. Because in this environment, what may be happening is that whereas you may not have that IPO that was expected, maybe you have a tender offer of other opportunity to take some cash off the table that perhaps is a different path that you had not originally anticipated.
Yeah. I mean, I think in Bay Area, homes being as expensive as they are, that money for a down payment is something that comes up a lot, right? And so people were waiting on that liquidity event to cover that. And now that it hasn't really happened, it's, it can be disheartening for some people. Just like any not being able to afford any sort of capital investment, expanding your family, adding on to your house, whatever it might be. And so maybe that requires an adjustment of goals, right? To your point about planning and thinking through different implications of things. But it also doesn't mean it can't happen, right? There are ways to potentially generate liquidity in the interim period prior to the event taking place, which have their pros and cons for sure. And I've definitely had a number of conversations with clients. Some decide to move forward with these ideas or strategies, others decide not to. But you definitely want to talk with an expert about them, with a wealth manager, to understand what your options are. So just to throw one out there, which I know you've worked with clients on, is the idea of using third-party liquidity providers in the form of lending against private shares or using your shares as collateral. If your company allows it, but using shares as collateral.
Yeah, it's a really common question that we get, and often is driven by the desire to do something like purchase a home. Because if you look around and you see housing demand just doesn't it has not weakened at all in the Bay Area. And you see housing prices go up and up and up, it gives you anxiety about not being able to tap into your equity to finance a purchase. So, as an example, the way that those loans are typically structured are collateralized by your private company equity. And so, what it can be advantageous is that they're structured as quote unquote non-recourse loans. And what that means is that the company cannot go after your personal assets. So if for
Hmm.
some reason you can't repay the loan, the liquidity event never occurs, you're not on the hook with respect to your personal assets to pay off that loan. Sounds pretty good, right? The flip side and the trade-off is that they often come at exorbitant interest rates. So we're talking double-digit interest rates, and because they're often quite large loans, you're not on the hook to pay that interest monthly or annually, but it does accrue into the balance of the loan. So pretty quickly, you're accruing interest on interest at double-digit
Hmm.
rates, in addition to giving up a percentage of the upside on the shares. So the company, the lender, will perform a valuation on your shares and then, structure a deal based on, scraping some portion of the upside. So it's typically reserved because it's so expensive. It's typically reserved for those folks who really absolutely have, a gun to their heads. Let's say that you have incentive stock options that are going to expire, 90 days after you exit a company, or
Right.
non-qualified stock options that have an expiration date, and you simply don't have the means to scrape together the exercise cost. That a third party lender may be a place of last resort to go.
But there can be tax consequences. Like, if the event doesn't
Yes.
take place, there's potential tax consequences, right?
Yeah, that often gets overlooked. So it sounds great to be able to get a loan that's non-recourse, but if the loan is written off, very frequently that can be an income event for you, a taxable income event for which you will owe a large amount of ordinary income taxes. And so that piece, some, kind of say that that's a problem for later. But it can be really, really material. And if you've already spent the cash that you received from the loan, it can be a big problem.
Yeah. It's gonna be, yeah, you don't want to have a really expensive mistake here, right? So if you were to
Mhm.
use this strategy in order to purchase a boat, right? And then the event doesn't take place, that's going to be a big problem. So you want to cross all your T's, dot all your I's, make sure you're accounting for all those risks, working with the right wealth manager, CPA, tax planning involved here, potentially cash flow needs, all that good stuff. So it is an option, but sounds like one that shouldn't be just reactively, uh, done. There's also, I know, the opportunity to sell some private shares if if companies allow it, selling private shares in some, these private sale exchanges, although and maybe we'll talk about this later, maybe not, but that can come with some risks as well because you don't have as much transparency or you don't necessarily going to get the best price for those shares as if you waited for the liquidity event to take place. So you really got to think about the discount you're taking if you engage in selling through one of these private exchanges. Um, well, that's a really good tip and strategy that one can take. So thank you for breaking that down. When when we talk about the delay, so we just talked a bit about, so, a struggle that can arise because of it, primarily around liquidity. But I think maybe more so or really interesting to people on this webinar is probably around using the delay to your advantage.
Mhm.
There's some situations where, yeah, maybe you're not getting your money's, it's 3 years longer than you thought you were going to get it. This event's taking place, taking 3 years longer or whatever the amount of time is, but that might actually benefit you in the long run if you take advantage of some things you might have not taken advantage of it happen earlier. So, like something that comes to mind with me is qualified small business stock. Under the One Big Beautiful Bill or whatever it's called currently that was passed recently, um, you can exclude up to $15 million of capital gains on the sale of your shares if it qualifies under QSBS, qualified small business stock. And there's rules around that, right? It used to be 10 million, now it's 15 million because of
Mhm.
that bill. There's also there's rules around what qualifies. So a company has to have only a certain amount of revenue when you receive the shares. It has to be a certain type of company. But let's say you didn't know about this, you didn't elect it when you sold your shares. If it had been a few years ago, if this event had taken place, you could have missed out on millions and millions of dollars because you had to pay it in federal taxes, which you wouldn't have now that you do know about it, and it's taken a little bit longer for this event to take place. So that's real savings and potentially the benefit of the delay and working with someone who knows about this stuff who can tell you like, hey, have you looked into QSBS? Let's look into it. Let's figure out if you're eligible and if so, what the ramifications are or the benefits.
Yeah. And in addition, under the One Big Beautiful Bill Act, more companies will qualify to meet all of those requirements to as a qualified small business. So that's going to be huge for folks who maybe their company was just slightly larger than was allowed
Hmm.
to qualify previously. And so that could be $15 million capital gain that you avoid entirely if you meet the requirements, but also understanding the rules behind how you can avoid that. And it's not a deferral, it's a complete avoidance of um,
Right.
15 million or more of capital gain. But if you understand those rules, then it can prevent you from taking actions like selling the shares too early that will disqualify you from that benefit.
Yep. Yeah. And so one of the things that comes up, maybe the most often in anticipation of liquidity events is taxes, which we just talked about QSBS. Um, and so people are saying, well, what else? I'm not QSBS eligible, right? These shares aren't. What are some other strategies that can be employed? And tax loss harvesting or versions of tax loss harvesting is something that's become quite popular, especially over the last couple of years of some new strategies and techniques. Just for those on this call who maybe aren't familiar with tax loss harvesting is, at its most basic level, you're basically selling an investment or an asset that's at a loss and using those realized losses to offset the sale of an asset that's at a gain in the future. And so there's some rules around it. If you sell one asset like a fund and you replace it with, you can't just rebuy the same fund necessarily, or you don't benefit from those losses. So there's some things you need to do to make sure you do it properly. But tax loss harvesting can benefit, by offsetting one bad thing against a good thing, so you don't pay taxes on it. But there's versions of it now that like supercharge tax loss harvesting that can be done before a liquidity event where there's a lot of proceeds to offset taxes, or even after the fact, depending on timing. I know, Teresa, you've worked with clients on some of these new strategies. If you want to touch on them a bit.
Love this strategy because, it's been around for decades, but it hasn't been available to, normal investors. It's only been available to institutions, hedge funds, et cetera. And because of basically advances in technology, now it's available to, everyday investors. You have to meet large minimums, but it can really magnify your ability to harvest losses. If you think about, a typical portfolio, let's say you have, a dozen mutual funds that you invest in, your opportunity to harvest losses is limited to each of those mutual funds falling to a loss, right? And so what this
Hmm.
strategy does is instead of investing in a mutual fund, it takes it a step further and invests in a whole basket of hundreds or thousands of stocks. So that already multiplies your opportunity. But then it also embeds on top of that long and short positions to really supercharge and leverage your portfolio to find more opportunities for tax loss harvesting. In some cases, we're able to completely offset millions of dollars of capital gains within just a few years. Now, it sounds great, but it also is a very complicated strategy. And like everything, it has its risks that should be understood. And it also places some limitations on your ability to liquidate the assets that are being used in the strategy. So just having a really clear picture and a long-term financial plan is key as the basis before thinking about any of these strategies.
Yeah, if someone had had a liquidity event 3 years ago, they might have not been able to benefit from this strategy. But maybe for some people, because it was delayed, this is now something they can have access to if they work with the right people. So it's a really powerful strategy, but to your point, it's super complex. And I think a lot of people want a silver bullet when it comes to taxes. They just don't want to pay taxes, right? Find a way that's like some strategy that has no trade-offs. That really doesn't exist, but there are certain ones that have better trade-offs than others, or depending on someone's financial plan, their liquidity needs, their long-term goals, values, all that good stuff. Some might work pretty well, and this is one that I think for a lot of clients is one of those.
Yeah, and
Um,
in particular, that strategy is really great for someone who has a very highly concentrated position in their
right.
portfolio,
That's right.
wants to diversify out of that position, but doesn't want to take the tax bite today. It's
Mhm.
it's a beautiful for transitioning that individual position into a very highly diversified portfolio of assets that no longer subjects you to the risk of having that concentrated position. And but importantly, it's not an avoidance of capital gain, it's just the deferral. So the ultimate benefit is that it allows you to continue to keep those dollars invested that you would have otherwise paid in taxes.
That's right. And that is I mean, the tax deferred growth is huge, right? That can make it enormous, especially for young people, that can be enormous. So shouldn't be overlooked. One last thing I'll mention on this, and then we should probably jump into the last kind of section is on estate planning. And so I think for especially younger individuals, it's a little amorphous because it's so far ahead, but you definitely want to have your estate plan in order, especially if you have a large event where you're going to get a lot of money. And if you have a delay, this might be a good time to do it before the event takes place, especially if you have children, if you have any complexities of who you want to receive the money when you die, if you live in California, avoiding probate by using a trust, all those things are super, super important. But there's also more advanced estate planning, like moving funds out of your estate so that if you pass away with an estate over $15 million per individual under current law, there's no taxes paid to the government in the form of state taxes, sometimes called death taxes, um, by using certain strategies, because that can be a very, very substantial tax hit that your beneficiaries won't receive that money if you don't do some planning ahead of time. So there's ways to do that, like putting your money into an irrevocable trust, so it's no longer in your estate, and you're kind of gifting before or now when you have this large event, and it can really pay off down the road. There's trade-offs, like with everything else we've talked about, where if you move the money out, give it to someone else, you might not have access to it anymore. Though depending how you do it, you might be able to maintain some access. or some value from those assets you've technically given away. So just something else I'll throw out there. I don't know, Teresa, do you have anything you want to mention on that? Otherwise, we can jump into the next part.
Yeah, in general, estate planning is very complex, but in general, when you shift assets out of your estate in the form of gift, either to charity or to loved ones, its value is on the date of the transaction, right? And so the name of the game is that you want to get that value out of your estate as early as possible at the lower amount, because every dollar that you gift goes against that lifetime limit of $15 million that you have. And so in the case of somebody with private company stock, or just stock that recently IPO but is expected to balloon, um, your advantage to do it earlier on, right? Before
Mhm.
the growth of the stock occurs. You want that growth to occur, quote unquote, out of your estate in the hands of somebody else. Otherwise, it gets taxed. And so one advantage of doing this before the an IPO occurs is because the valuation of the shares is more stable than it is once it goes public. So once shares go public, then the stock price becomes volatile, goes up and down with the market, and it can be more difficult to plan around that from an estate planning perspective when you don't know what the value is until the transaction occurs. So it's a side benefit. It shouldn't drive, the timing of when you do something, but it's just something to consider.
Definitely. There's a lot of things to consider, so I think part of the process is thinking through what are really the things to focus on and all these different strategies we've mentioned, and a ton more we won't be able to mention when there is a delay, or even if there's not a delay and there's an upcoming event that you know when the date is and it's happening as planned. So working with the right, wealth manager, tax planner, estate attorney, right? That's really important for what we're talking about is kind of key. Don't try to do it alone because you don't know what you don't know. And there's a lot out there.
Yeah, one example where we have used timing to our advantage, or more time to our advantage, is educating clients about your ability to stack that qualified small business stock capital gain exclusion. So each individual can exclude up to 15 million or more in capital gain on a stock. But if you gift some of those shares out of your estate, you could have the potential to multiply that gain exclusion um, by several factors. And
Hmm.
so, just having more time in place will allow you to do the financial modeling with your planner, with your CPA, make sure you understand the trade-offs. But, we have some clients potentially saving tens of millions of dollars of qualified small business stock capital gain.
Yep. Numbers can really big if you use some of these strategies. All right. So we've covered some good stuff there, some strategies, thinking about taking care of some liquidity concerns. Let's jump into thinking about when the event actually happens. The delay is done. The IPO event is going to happen any moment, or the merger and acquisition is expected soon, or a tender offer comes up. What mistakes do you see when the event actually takes place with clients that you've worked with?
Yeah, I would say one of the most common responses we see is anchoring. So let's say that your company goes IPO and the stock climbs really shortly after the offering. Over 30% of shares will climb immediately after the offering. And then you've anchored to that price in your mind such that you don't want to sell at any price below that number. I think
Hmm.
the flip side of that is that people often think that it's just binary. If I take this off the table, then I've, stopped value at the price that I've, sold the shares at, but they tend to discount the fact that they would also be investing those proceeds otherwise in the market very commonly or typically. And so that's one component of it. But also just understanding that nobody has a crystal ball, and the trade-off to anchoring to that price is that you may not ever reach that level, but also there's a time value component of not taking that risk off the table, or earning on those proceeds in another investment. strategy. So that's just really common and it makes sense. It's common to do, but this is why it's really important to think about and have a game plan for what value or what dollar price you would be willing to sell the shares at before the IPO occurs. Base it on your expectations for the company and discount maybe market exuberance that might push the share price up or down immediately after it goes IPO.
Yeah. Yeah, well said. The one I see often, and you probably have as well, is when the paper money becomes real money, it can have a paralyzing effect on people. It can be a lot. It's a transformative event in people's lives they may have been waiting for, but now that it's here, it's like, oh wow, there's millions of dollars in my account. Or even if it's hundreds of thousands, that can be, very substantial, obviously, for people. So, especially, people who might not have as much experience with liquid wealth like that. So it's, making sure, and this goes along with what you're saying, I think too, is planning ahead of time, thinking about the price point that you're comfortable with. But just thinking about your plan holistically, how do you want to use this money? What does your life look like? Talking it through from a technical and an emotional standpoint with an advisor so that when those funds do show up, you feel more ready for it. You feel like more of a steward for your wealth. I think that's really, really key, and it gets lost in all of the technical details because the emotional component is just as important as anything else.
Yeah, I think that's really well said. I think most people, you know, in particular, those who haven't worked with a financial advisor in the past, they focus on the technical components, and that is all table stakes for sure. You need to have an advisor who is well versed in all of the taxes and estate planning and financial planning considerations. But equally as important is finding that advisor who understands these behavioral and emotional components of investing and how to help you through paralysis, for example, or anchoring or other, keeping up with the Joneses types of narratives that might be going on in your mind as you try to make these decisions.
For sure. Uh, I think that's a great place to end the conversation portion. We have a few minutes left. We really got into it, so I think we covered a lot of good stuff. We maybe not as much time for questions as we would have liked, but let's try to knock one off before we end, which is, let me look at it. Okay, so how do I buy, and I think we mentioned selling private shares, but how do I buy private company shares? And I'll add on to it, what are the risks involved? So quickly, just one of the first things that comes to my mind is having a lack of information. If you're buying shares on one of these private exchanges, um, with public companies trade on a public exchange, you see quarterly reports, you can listen to the calls that they have. You can just type in Google and get a ton of information about them because of the requirements of what they have to share. Private companies are a lot less transparent. So if you're trying to buy those on a private exchange, even if you know the name, you think you know all about it, there's just that embedded risk of not having that information when you make that purchase, which is important, right? You want to know what you're buying.
Yeah, I think the other component that sometimes gets overlooked is the lack of liquidity availability. Once you make that investment, it's not like a publicly traded stock or bond that you can go and sell as you need. You may never get liquidity from that investment, or it may be 5 or 10 years, or you may just have zero visibility into when that may occur. And so just keeping that in mind as an illiquidity discount, if you will, when you make that investment is key.
Yeah, and if you do want access to private investments, there are ways to do it in the form of funds, right? Private funds versus investing in an individual position on one of these private exchanges, which you're working with someone, a manager who can do the due diligence, give you a more diverse holding, and working with an advisor that can get you access to these kind of opportunities potentially.
Yeah, I really like the private fund vehicle because you have access to managers whose day-to-day job it is to collect and information about these private investments, and also that can offer you a diversified basket of private investments as opposed to concentrated individual positions. So it allows you to add diversity in the mix if that's something that could benefit you.
Awesome. Well, thank you, Teresa. That's all the time we have. Hopefully, this was really helpful. We tried to pack it full of information for everyone. So, thank you so much for joining. Again, as I mentioned, there you will receive an email with the opportunity for the complimentary planning session with Teresa or myself. So please look out for that. Um, and we really hope to hear from you. We really hope you enjoyed this webinar and that it was helpful. And we hope everyone has a great rest of their day.
Thanks,
Thanks,
everyone.
Teresa. All right. Bye.